Hello, and welcome to Bloomberg Opinion Conversations. I am Brooke Sutherland, an industrial columnist, and I am joined today by my counterpart in Asia, David Fickling, and we are going to talk a little bit about the shipping crunch that is impacting so many different kinds of industries all across the world. And David has written a couple different columns about this, and we're just going to talk about what's behind this, what we can do to fix it, and what kind of ramifications it might have. So, David, just to start out from the beginning, I mean, you've seen pileups at the ports on the West Coast in the US. There was a container ship stuck in the Suez Canal. Now we're having issues with the key port in China where people are getting sick and not able to come into work. What is happening here? Are all of these events connected?
Yeah, in a way they are connected. The container shipping system operates at very low margins, at very fast turnaround times and speeds, just in time. And at normal times, everything just about works. When the supply of container ships and shipping containers runs ahead of demand for products to ship on them, then you tend to have low margins or even negative margins, but the system works. What we're seeing at the moment, though, is that demand is running ahead of the number of ships and the number of containers. So the margins are surging, but the system as a whole basically falls over. That's what we're seing right now. A 40-foot container, sort of standard shipping container, to move that from Shanghai to Rotterdam, back in 2016, when there was a real glut of shipping and costs were very low, that would cost you about $300. So that container can carry 30 tons. So it's about $10 per ton. It's extremely cheap.
Oh, wow.
The break-even cost for the shipper is about $2,000 on that shipping container. Right now, it's over $11,000 a ton. So the shipping line is getting excellent margins at the moment, which is making up for years of very bad margins before that. But there's so little slack in the system that any small problem can have these sort of cascading effects that can go on in many ways for months. And that's causing some of the problems that we're seeing at the moment.
So is this all pandemic related then, or were some of the forces in play that's causing this crunch pre-pandemic? Were there certain aspects of the environment that set us up for this type of environment?
I think that's exactly right. There is a pre-pandemic aspect to this, and it goes back, depending on how you measure it, it goes back 3 years, it goes back 7 years. There has been a long lead up to this. Going back 3 years, if you look at a chart of global container shipping volumes, trade volumes, they peaked in sort of late 2018, because of course we tend to think now that the pandemic is the only dramatic thing that's happened in trade over the past years, because it has been so dramatic. But there was a big trade war going on before the pandemic started that was just coming to an end as it started. So those trade volumes, they peaked, as I say, in mid 2018. All the shipping lines, of course, they're paying attention to that. If they're seeing trade volumes peaking, and a lot of commentary at the time with the Trump trade wars and the Chinese aspect of that, talking about this dual circulation strategy being less dependent on trade with the outside world, people see that and they say, well, we need to invest less, because otherwise we're going to have another oversupply of shipping and our margins are going to get crunched. Even before that, there was a massive glut of shipping. As I said, 2016, you could ship a ton from Shanghai to Rotterdam for $10. That was that was a very difficult time for the shipping lines. They overinvested in the early part of the 2010s. Since March 2019, so that's really sort of 2 years at this stage, Maersk, the Danish company, which is the world's biggest container line, their total capital investment over that pretty much 2 year period is about what they spent in a single quarter during 2014. And most of the shipping lines are not actually listed, but that's pretty representative of the industry as a whole. If you look at things like the order book of new ships, they're always having to buy new ships because they wear the old ones out. Traditionally, I mean, back in the 2000s, the order book was always about 30% of the existing fleet. It descended to about 20% in the early 2010s. It's since for several years now been below 10%. So if you look at the chart of that, it's gone down and down. The investment in the future fleet has just really crashed. And only in the last few months, there's suddenly been a big surge. It's up to 15% or so, because the industry is seeing we have a supply and demand problem, and we actually need to invest a bit more. But it'll take a number of years for that to happen. It takes 3 years to lay down and launch a big new container ship. So we're not going to see relief of that immediately.
But if those underlying reasons were driving the industry to build less ships before the pandemic, is it the right response to all of a sudden crank out more ships? Or do we eventually get back to the same dynamic? I mean, I think about, in my coverage, I cover FedEx and UPS, and they're quite happy with the margins they're getting right now on their side of the logistics equation. They are not in a rush at all to add back air freight capacity to try to balance things out. So how are the shipping companies thinking about this right now?
Yeah, this is true. And I mean, I think it's worth bearing in mind with this that shipping doesn't just carry commodities like oil and iron ore. Shipping is a commodity. It costs the same on a similar route across the world. It's not, one shipping company is not better than another. If I'm shipping a car from Japan to the US, I don't choose one shipper because I like the brand. It's very, very commoditized. And that means it behaves like a commodity market. And commodity markets, as we know, are characterized by boom and bust. Every shipping company would love to avoid the world of boom and bust. But when you're in the commodity business, generally the way to avoid boom and bust is not actually to it's not to not invest, because then you're just going to get squeezed out of the market. It's to be the lowest cost player in the market. That's why Saudi Arabia is so dominant in the oil market. It's why the sort of iron ore mines of Australia and Brazil are so dominant in the world. You need to be at the bottom of the cost curve. Now, if you're a mining company or an oil company, the way to do that is to make sure that you've got the best geological deposit. But the shipping industry is not geological, so to have the lowest costs, you need to invest in the technology that has the lowest cost. Generally, what that means over the last decade or so is that you have to have the biggest ships possible. There's a fairly direct relationship between the size of the ship and the cost per container. And as ships get bigger, the cost per container goes down, the amount of fuel you need to use goes down, the amount of port time you need per ship goes down. And that's why we see these, you will remember those photos from a few months ago of that ship, the Ever Given, that got stuck in the Suez Canal, a 20,000 container ship. Go back 20 years, and a lot of analysts would have predicted that ships of that size were actually not possible. They couldn't be constructed, and they couldn't make a profit. And now that's a fairly normal size ship. It's not a particularly large ship.
So, I mean, I think what always stuck with me from the Ever Given is that image of the excavator on the side there trying in vain to dig it out of the canal. So is there room to push ships bigger? I mean, can you expand them? Can you build them taller like skyscrapers? I mean, what sort of options do you have if you're trying to get that lower cost vessel, but you want to do it in a way that makes sense for the industry?
At this stage, it's getting pretty difficult, but I have to say we've, referring to my last point, we've always said that we're reaching the hard limits, and we always seem to get past them. The Ever Given 20,000 containers, we'd have thought that was pretty much the maximum size, and 3 or 4 years ago that would have been the biggest ship on the seas. Now there's about 120,000 TEU ships either sailing or under construction. And there's the bigger ones are 24,000 TEUs. There are ones now sailing that have 24,000 containers, and there are ones that have had designs lodged for 25 or 26,000 containers. So it keeps getting bigger. There are real physical limits that we're facing, and I'm glad I'm not a ship architect, because I'm not sure how you would design them. For instance, the containers themselves, they have the sort of compressive strength for you to have 10 to 12 layers on a ship deck. You can't get any deep. You can't build it up like a skyscraper, because the ones at the bottom will get crushed. So that's not going to work. The ships are about 60 meters wide. Similarly, you've got some problems with the structural strength of these, the steel cranes that go over and take the containers off. It's quite difficult to make them much wider than that. They're already sort of towards their limits. Maybe there's sort of design innovations that can help with that. And again, the length of the ship at about 400 meters at the moment. that is pretty much at the limit, because of course every port in the world has built quays to accommodate ships of up to 400 meters. It has not built quays for ships of 500 meters. And in some places like the Straits of Singapore, it's hard to, you have to turn it very rapidly. So much bigger than that. There has never been, I think the biggest ship ever that was an oil tanker of about 430 meters. It's for navigational reasons quite difficult to get much bigger than that. And then, of course, depth as well. These ships, when fully laden, will go 20 meters below the waterline. In a lot of ports, they have to wait for high tide to get through the ship channel and into the port, because otherwise they would ground going in. And it's not just ship channels. The Straits of Singapore and Malacca themselves are not much deeper than 20 meters. So you can't really go that much bigger without really rethinking a lot of fundamental things about the geography and the engineering of the shipping industry that we've really not begun to think about yet.
So it seems like, you know, the only real solution to this problem is to build more ships. But as you said, that takes a couple of years. And so, I mean, is this the type of situation that will just work itself out over time as, you know, people get vaccinated and start spending money on services again? Or are we stuck with this for a while until the industry can make more capacity?
I think that point you make about services is an interesting one. And I think that's going to be worth following over the next few months. I mean, if you look at these charts of shipping volumes, they leveled off, as I say, in sort of 2018, and they're obviously plummeted in early 2020, and they've surged back, and we've surged back certainly above the post 2018 trend. We're sort of heading towards something, you know, well above that. And the question is, what's driving that? And one thing that is worth bearing in mind, I think, you know, if you look at these statistics for, you know, US durable goods orders, they're through, that you would have been writing about this and following it. They're through the roof, because of course, yes, we can't spend money as much as we did once on services, on going out, on you know, going to the movies, all that sort of thing. So we have this spare cash, and I know for myself, and I think most people are the same, we have bought more manufactured products because it's the only thing we can do with the, you know, those of us who haven't lost income during this pandemic. It's a thing that we can do with it when we can't use services. But that's probably going to reach its limits. As we start using services more, then that ought to shift. And there's only a certain number of, you know, durable goods you can buy for your household to some extent. So so this possibly is just a blip. And possibly the thing about shipping is it's always unpredictable. Any prediction you make is wrong. Possibly this very substantial investment that's going on is being done on the basis of an expectation that trade volumes are returning to a pre-2018 climbing path, when in fact we're still actually on a more flat path. And it's just that we're having a sort of durable goods boom. So that would certainly ease things off quite substantially.
Is it also a pricing issue? Because I know, I mean, freight costs are up across the board, but I think if you look geographically, there does seem to be a big differential in terms of what you might pay to get a ship across a different part of the ocean. Can you unpack what's going on there a little bit and what is happening?
Yeah, I mean, this is one of these things where we talk about a sort of cascading problem that goes on for months. Now, I mean, trade volumes were really picking up from mid to late last year. And then there was the usual sort of Christmas seasonal surge, and they picked up with that. But they were picking up from these very low levels. And the shipping industry, being a just-in-time industry, being a very you know, low margin industry, was trying to shift as fast as it possibly could to cope with this new situation. Now, ships turn around very fast. In container ships, they turn around in a day or two at a port, even these huge 20,000 container monsters. But every hour counts. So what a lot of them started doing is, instead of picking up a bunch of empty containers when they reach Rotterdam or Los Angeles or New York, and then turning around and going back to China, they just left the containers. They didn't have time to pick those up. And so they went straight back and picked up the next load from China. Do that for a while, and of course, what happens is you end up with a load of empty containers stacked up in ports in Europe and North America, and a real shortage of containers in China. And that's why we're seeing these very dramatically differential rates. Now, rates have gone up everywhere because that's the sort of nature of the industry. But the gap between the outbound routes from China and the return routes is really dramatic at the moment. It costs about 8 times more to ship a container from Shanghai to Rotterdam than from Rotterdam back to Shanghai. And that you're seeing the same thing in Los Angeles and all those ports. Whereas interestingly, on transatlantic routes, there's obviously, Asia is not the only route of trade. There is this, Rotterdam to New York trade, this sort of thing. Those rates are at the normal levels. There tends to be a dislocation because there are these sort of supply and demand issues about where the containers are and how you get empty containers to other destinations. But they're at normal levels there. The ex-Asia routes, the ex-China routes are at crazy levels, and that's actually a good thing. That's a price signal to everyone in the market to rebalance. You're still at this stage will have shippers who are reluctant to pick up empty boxes and take them back to Asia because they just want to save a little bit of time. But you're getting a really strong incentive there because, of course, if they can get that box in Asia, that's going to lower that's going to lower some of the costs, and the system will balance itself out.
And I guess that gets back to what you were saying, just how carefully orchestrated this whole system has to be. And if you end up with containers not in the right space, it throws everything out of whack. It does make me think about manufacturing and how just-in-time manufacturing is coming under a lot of scrutiny, specifically with the auto industry facing a chip shortage. I mean, as you look at not just shipping, but the economy in general, do you think we're seeing a moment of reckoning for this sort of dogged pursuit of efficiency at all costs? Or do things snap back and margins reign supreme again once we get past sort of the immediate pandemic moment?
No, I think you're right. I think we are seeing a bit of a reckoning. And the only small caveat I'd add to it is that a lot of people, I think, in the industry have been quietly waking up to this for a little while. And the pandemic, I think, was a hammer blow to it. But there was a growing awareness of this. My colleague Anjani Trivedi was writing about this in relation to Toyota, and I've written about it myself in the past. Toyota, of course, are the paragons of just-in-time manufacturing, and they've built the entire business around it. An interesting thing, if you look at their inventory days, the number of days where they hold products on their own inventory, traditionally, like minimizing inventory days is a great indicator of these just-in-time efficiencies. And if you look through the 2000s, Toyota's inventory days, I'm drawing the chart the wrong direction there. If you look through the 2000s, they went down and down. They went down and down and down through that period. 2011, they started to turn around, and they've gradually been turning up from, I'm talking from memory here, from about 11 days to 20 days pre-pandemic. And I think they'll be up beyond there at this point. Now, what happened in 2011, you had two crucial things, I think. There was obviously the Tohoku earthquake and tsunami, which was very damaging, obviously, for the home market for Toyota. And also, let's remember now, there were these very big floods close to Bangkok, where a lot of the auto companies have some substantial parts factories there and assembly factories, which also caused supply chain problems. So we have seen a gradual turn away from the sort of extremist just-in-time fanaticism over the last decade, and I think this will certainly, take us further down that road. And I think so. There's a tendency now to hold a little bit more on your books, to have a little bit more working capital, and just to save you in those difficult moments like we're having now.
I agree. I just wonder how long it takes for some activist investor to come back around in 5-10 years time and say, why aren't your profit margins what they used to be? Why aren't your inventory turns what they used to be? But that is an economic cycle for you, I suppose. Last question, and then I'll let you go. Is there anything that companies who are shipping goods should be thinking about? Anything they should be doing differently? I mean, to sort of ease this for themselves? I mean, are there alternatives to shipping your products via boat right now? Can you look at air freight capacity, or is it just sort of, it is what it is, and you have to find a way to manage through it?
The alternatives are not great in terms of other routes. If you can do air freight is obviously, it's a very good business at the moment. Air freight has had a very good pandemic because obviously there's not been a lot of demand for passenger, for passenger air freight, but there's a lot of demand for for light, high speed delivery of stuff. Obviously vaccines are the obvious one, but also things like PPE, and also a lot of light goods, things like clothing has often been shipped by air. And of course, we were talking about the chip crisis. The chips are an air freight business, so it's been good for that. And for a lot of airlines that have really struggled on the passenger side, like Cathay Pacific, like Emirates, they're still in a lot of very difficult place, but the air freight industry has really helped them. The trouble is the sort of things that you ship by ship do not suit themselves very well to go and buy air freight. You can't ship cars by air freight and make a profit, and you can't ship fridges by air freight and make a profit. The one place that sort of sits in between those a little bit, and this doesn't really work for North America, but it does for Europe, is of course rail. China, as part of its Belt and Road Initiative, has been very strongly pushing overland rail. Really, there's a sort of geopolitical strategy to this. They are concerned about getting cut off in the Straits of Malacca, shipping cut off to China. So they like these overland routes. And there's frankly very large subsidies that China pays for overland rail via the Trans-Siberian Railway. It is at normal times, it is substantially more expensive than shipping by on a ship. But at these levels, it's actually a decent alternative. And so for products that are small enough to go by that you certainly see a lot of stuff like laptops and small electronics that traditionally some of that has come out of China by rail. But the one thing I point to is that the volumes are tiny and the capacity is tiny. The entire Trans-Siberian Railway, its annual container volumes are roughly what you would get on a single container ship, maybe a little bit more. Because with all these subsidies, it's been picking up a little bit. Certainly less than you get on 2 container ships. And of course, there's as I say, there's 100 of these larger size container ships out there. So it's not really sufficient to take up this problem, which, as we said at the start, is a problem of excessive demand relative to capacity. If you can get your products on the Trans-Sib, it's probably a pretty good time to do it. It's not going to help you with North America, but it might help you a little bit with Europe with some products.
I should say, though, that, in North America, we do have Canadian National and also Canadian Pacific trying to buy Kansas City Southern on sort of a bet that we will see more of a nearshoring of manufacturing work and take some of this container shipping element, air freight, out of the equation, and that you would just ship goods across the border from Mexico into the US and Canada and do it in a more streamlined, cost-efficient method. But, that deal is still before regulators, so we'll see if that actually comes to pass. But David, thank you so much for taking the time to talk with me. This was so helpful and insightful, and I really appreciate it.
Thanks very much.